Swayam Prabha. Digital India. Educated India.
Hello, welcome to this 9th lecture of the lecture series on ESG analytics and green finance. My name is Atul Tripathi and I am an honorary adjunct fellow at National Maritime Foundation. So today we'll be talking about very interesting space regarding what are the various ESG ratings, why does it matter, how do you calculate your ratings, and most importantly, the role of artificial intelligence in the blockchains and the GIS of the world. We'll also go through some of the platforms that are popularly available. How can people participate? How can they look at it? How can they play around with those platforms? So let's go ahead and see what we're talking about. So one of the things that we need to look at is it's a $40 trillion decision making we're looking at. Now, this is as per GSIA report 2023. That's about 1/3 of your professionally managed assets globally. That's a large number you're looking at. And, the implications are not niche. It's actually a mainstream in terms of, it has been mainstreamed rather in terms of capital allocation. Because ESG scores are now influencing your capital flows, your cost of borrowing, your valuation of multiple times, your reinsurance and all these things that we have been discussing about over and over again. Now, the sovereign bonds act is being influenced very heavily because you're higher the ESG scores, lower is the yield. And for corporates, the better the scores, the cheaper is the debt, and for broader is the investor pool you're looking at, because investors have become very sensitive in this regard. And you can really see how things have been happening over a time period over various regions now, and the proportion of the global investments that have been happening over and over again. So in terms of Europe and US and Canada, Japan and Australasia, and that includes your New Zealand as well. So this is a large number we're looking at. And the important thing is the methodology. So we'll talk about that in detail as we come down the line. One of the things that we need to look at is there are divergent scoring. So one company can be AAA in one framework and a B in another framework of the ratings, ESG ratings by various organizations. We will discuss that, why it is happening, how it is happening and all that. Take the case of Tesla, and it was ranked very well in one of the environmental innovations in one of the rating agencies, but it was penalized heavily on the governance factors by another one because the governance controversies that surrounded it. We'll see it as a case study in the coming few minutes, This also creates a confusion in terms of the customers and investors and the volatility in perceptions, the potential misallocation of funds and capital. And therefore, you need to be very clear about all these factors when you're doing your ESG investments, your allocations of funds and all that stuff, because the strategic implications for the investors is in terms of the ratings or in terms of inputs, So basically, you're cross-checking across the agencies, which is becoming very important. Then the firm's ESG story must be actively, managed and so as to avoid any rating divergence risk that is going to be associated with it. So that brings me to another point, and that's about your ESG ratings. And that's what I said. It's about a $40 trillion economy you're looking at, because the signals that the investors is something that the investors just cannot ignore. Because as I said, one company AAA rated by MSCI being rated B by Sustainalytics, and the market speaks volumes in terms of the multiple dialects that we're looking at. So look at this case, Berkshire Hathaway. In Sustainalytics, it ranked pretty high on the green side versus FTSE, it ranked in the negative side of the Berkshire Hathaway, and MSCI also ranked it in the negative side. So this is a very interesting case study, because one of the points that comes around is ESG as a capital magnet has become a capital magnet, because Global Investment Alliances, GSIA, reports that over $40 trillion in assets, more than 1/3 of being professionally managed money, So now it is being embedded in the ESG matrices across the board. Then they have the influence beyond the equity market, because the ratings are being influenced based on your bond yields, your lending terms, your insurance underwriting, because that is effectively becoming a hidden layer in the corporate cost structures. And that's why this ratings is becoming very, very, very important, I would say, an extremely important factor when you're looking looking at the capital allocation across the board. Then the divergence challenge is one big area, because ESG ratings are lacking any universal standardization. So as I've given the example of this Berkshire Hathaway, to look at it across the board, how it is being played around by various agencies or ratings agencies. So there is a lack of common dialect, I would say, across the board so as to make sure that companies are being rated across based on certain factors across on the more or less similar lines, not as divergent as positive in one while the negative in other two. That's an important factor. Then the investor confidence and price signaling becomes very important, because the stronger your ESG ratings, the more it will be able to attract the capital inflows, because that is leading to your lower cost of capital. It is boosting your valuation. So weak scores will lead to exclusions from the funds of the higher borrowing cost. So divergence is a very important factor. As I said, ESG ratings, there's a complete lack of universal standardization because the methodologies are differing. That's the primary reason. Some are giving a lot of weight in terms of environmental risks, which is becoming very heavy for some of them, while for the others there's a prioritization on governance. For others, it is a prioritization of social factors. So all these factors, there are the reasons. There are multiple reasons why this is becoming a very divergent field in terms of ratings by the ratings agencies, and that is having a very big strategic implication, because you need to understand the methodology behind the rating, which is becoming very important in the rating itself. So any savvy investor is looking at multiple providers, across the ESG analysis, so that they can triangulate in the company's true sustainability profiling, and that's a very important factor that it has become in the given days. That brings me to another point, and that is how are these being, the ratings being done? What is the score? How do you calculate that score? Because an investor managing over $40 trillion is using ESG data to make decisions, and yet they're still not fully understanding what is happening in the E and S and G factors, which is being measured. This is as per GSIA. So E actually is talking about your environment, whether it's climate impact, energy efficiency, resources, because there you're looking at carbon emissions, renewable energy shares, water output, social factors when you look at labor practices to product responsibility, where your indicators can be in terms of diversity of ratio versus supply chain audits. The governance factors can be leadership oversight, ethics, transparency, where your board diversity, anti-bribery measures, they are becoming important factors. If you look at this as per MSCI ESG ratings key framework, they have defined it into 3 different pillars. This is just an example for everybody's sake. So this is one of the ratings agencies, and what they have done is they have defined it in terms of various pillars. So they have the environment pillar, you have the social pillar, and you have the governance pillar. So that brings me to another point, is why are these dotted? Because these are the key issues based on selected of soft drinks subsidiary for a Coca-Cola that they have taken. And then there are certain universal issues that are applicable to all the industry. So governance pillars, this is applicable for all. In the case of MSCI ESG ratings, they have kept it constant. They are not diverging from it. But depending upon the kind of product, so if you take the case of Coca-Cola as an example, they're looking at carbon footprint, water stress, to health and safety, product safety. So these are becoming important factors when they rate the companies, because you see ESG ratings, they are not only about moral badges. They are strategic business metrics where you're looking at investors, regulators, consumers, and they're watching it continuously, because an ESG rating is assessing how well a company is being managed in terms of environment, social, and governance pillars, and the responsibility, the governance structures that their companies are bringing on board, and they are forward-looking indicators. They're not just backward-looking in terms of how the performance has been measured versus in the historical data or in the history in past. Because think of them more as an X-ray of the corporate health rather than anything else. Because what is the situation at this given time period? And that is why, these ratings are being influencing the access to capital, and the shareholders, how they are using them for a long-term resilience in the volatility market across the board, and the regulators and the stock exchanges, how they are increasingly incorporating their ESG disclosures to listing the compliance and requirements all the way across the board. And that brings me to another interesting factor, and that is how do these ratings are being taken care of. So one of the ways they start off is in terms of the sovereign ESG ratings, where the pricing the resilience into the nations itself, because the sovereign ESG improvements are strongly correlated to the trigger CDS spreads, and ESG now is able to explain about 73% of the spread variability, that is as per central banking analysis of sovereign ESG versus CDS spreads. Now look at this map across the board. So when you look at the world map, they have got all kind of scores. So there are a lot of factors that they have taken into consideration. Politics obviously being one of them, geopolitics being one of the important factors that these rating agencies do take into consideration. So if you look at the Europe versus Americas versus even the Eastern Europe to Asia to Australia and to South America and all these areas to Africa. So a lot of areas in Africa, they're still not been priced out, they've still not been able to rate out, because the sovereign ESG ratings, they are very valuable in terms of the risk signals, in terms of informing the pricing, the portfolio diversification. What about the sustainability linked investment decisions, especially under the, when you're looking at the forward-looking climate and governance risk factors at the national level itself. That's why these are becoming very important, because the sovereign ESG is increasingly driving your bond yield spreads to the developed, particularly in case of a developed economies, better economies, better environmental scores is leading to consistently will lead to your lower spreads versus in emerging economies where social dimensions will play a very, very important, stronger factor to look at it, because ESG is adding beyond your traditional credit ratings. So some countries like Costa Rica, for example, they are displaying strong ESG credentials but receiving moderate credit ratings. Now that's a very interesting point, because there are a lot of indicators in ESG which is often being supplemented. So you have various advanced models like Maple, Crofts, or where they're using a high frequency ESG data to signal the price movements to the market sentiment, so as to more dynamically price them out. And let's try and look at some of the platforms that are available by risk indices. So you can go to this platform and you can see what is happening at the various. As I move my cursor, you can clearly see how it is happening, what are the scores out there, and the ranking that has been given. So India has got 139 rank, China 115, Russia 106 versus America, which is 40th. Canada has got 13th, and the Scandinavian countries are very highly ranked, So Finland has got rank 2 versus England, which has got rank 34, and Iceland is the highest ranked. So they've appropriately put a score as well. And this is across the board, where participants or the students or anybody, they can see. And this is being updated at a very fast pace as well. You can download the data, you can see what is happening. On the similar lines, there's another website, by the World Bank, and you can go and do a more detailed understanding around it. So let's take the case, I've taken the case of Saudi Arabia, which is slightly high income economy lying in the Middle East and North America. And you can clearly see what's happening out here. So they have developed these scores based on the population, the growth, the surface area, the GDP, and how this is being played around. So you can also look at your sovereign ESG profiles, because they're looking at cooling degree days, coastal protections, heat indices, what is PM 2.5 levels. So, and also when did they measure, what was it happening, across the board, and look at this agriculture and forestry. So, another one that we're looking at, in terms of Saudi Arabia, how it has been happening over a time period itself. A pretty good learning platform for all the participants. And that also brings us to another interesting factor is land coverage. So if you look at it, if we can also do multiple analysis. So I've taken here the case of a land coverage, primarily being an open barren lands out there. That's why it's the circle, the largest sector is in terms of barren land versus open shrublands to greenland and all that stuff. That also brings me to another case study, and that is in terms of the Myanmar as a country. So here again, the same things, multiple factors taken into consideration, where they have ranked the country based on their country's profile. What is the GDP in terms of the per capita inflation, or all that factors. Then the governance factor also out here. When did they measure last? What was the value that they have brought forward together? The social factors. things like access to electricity, to life expectancy, to population ages 65 and above, to school and enrollment. So one should definitely go and understand how these ratings are being done, sovereign ratings out here. Look at this one. You can clearly see how it is happening. And within the areas, within the same, the region itself, geographic regions, so they also do a comparative study like Papua New Guinea versus Myanmar. You can do a study. Vietnam is there. The entire population areas. Interesting things out here. Again, if you observe, again, the same thing, you can add various factors like your data sets can be added up. You can see the changes that occurs. You can look at the various projects that have been happening. So if I was to take again the case of data set, if I was to remove this and I was to add, say, net foreign assets, so look at the way it has been changing. A pretty interesting platform to look at for any participant in this area who are interested, and they should be looking at these various platforms that will give them a good understanding how these ESG ratings take place, what are the approach, what are the methodologies that these ESG rating companies take into consideration. A very interesting and open source based stuff you're looking at. That also brings me to another point, and from data to decision, how do you reach a decision factor? How, once you've calculated your score, how do you come down to the various factors? So MSCI assigns about 50% of the weight to environmental matrices, as I said a few minutes back, in extractive industries, but less than 20% in financial services. So various agencies, various approaches that they take into consideration, because you need to, the weighted averages where MSCI is taking into consideration is, they're taking the ESG scoring, and it is not a one-fit-all model we're looking at, because each industry has its own unique potential profile in terms of material risks. So take the case of a mining company, which is being judged heavily in terms of carbon emissions, to water usage, to biodiversity, while a bank is being rated more on the governance, the lending policies, and the social risk management factors. And that also brings me to another point, is about metric selection weighting. So matrices, they are being selected based on the relevance, the materiality or the materiality as we call it. And then you assign them weights based on their perceived financial impact on the company's long-term performance. So weights can generally range from 10 to 50%, I would say, given the dimension that is there for every of these sectors. So then you do the score normalization as the third step, so as to ensure that there is a comparability across the companies of different sizes, different sectors, different places, geographic locations across the board, and the raw scores that have been there, which has been collected. So they need to be normalized based on their industry peers, or even the other industries that are there and the similar sector, or on a very, very close sector, I would say. So your final ESG score calculation is, based on the weighted matrices that have been aggregated across your composite ESG scores, and the variations in methodologies where you're calculating the mean of the same company can change vastly across different ratings from different providers. And finally, when you look at it, is in terms of strategic insights for the investors. When you look at that perspective, that understanding is going to help in how the score was constructed, because it is a very, very important factor, because the score itself is very important, because especially in terms of your ESG ratings, because you're trying to do capital allocation, your portfolio screening, or regulatory compliances. And, if I was to use another case of Sustainalytics, and if I was to take you to the second platform, it's a very popular one. Again, you can search a company's ratings, you can see what is happening out here, you can check a company. So take the case of automobiles as a company, you can filter them down, say I'm keeping it high risk, and I can play around with this thing, and it'll give me the list of all the companies that are there on the high risk in the automobile sector. Why is it so? What is the scoring you're looking at? So if you look at Maruti Suzuki India, why is it so? It will give you an understanding out here. There are multiple companies that they have taken across the board. You have Thor, you have Triguna, and a lot of Yulon across the company. So another thing, if I was to take the same case on a case of, say, medium risk, if I was to play around, look at the way the companies are changing. So from Aston Martin to BAIC to BYD to Ferrari, Ford, Honda. A lot of companies are changing. The ratings keep on changing. This is a very, very company driven and by the Sustainalytics as a platform. A very good platform for any individual to go around and check what is happening, how it is happening, what is the game that is being played around, how people need to learn about it. Sustainalytics is a very, very important platform, I would say, and I would recommend highly for everybody to go there and see what is happening. And that also brings me to another point, and this is another way of doing it is you quantifying the probability of impact on the industry. So the companies with high ESG scores of 4.7x more likely to face material business impact within 3 years as per MSCI ESG ratings. So here you try and look at more in case of probabilities of the ratings that is there. So it is a risk-based ESG model that is shifting from the historical performance to a more of a dynamic probability-based approach altogether, where you're doing more dynamic forecasting, and you're using you use historical data, the incident data, the forward-looking indicators, the industry-specific factors altogether, and then you calculate the likelihood of the financial material ESG events such as, say, oil spill or a labor strike or a governance scandals within the defined horizon altogether. And that gives me the weighting by the materiality, which is not all ESG risks are equal, because the model has to adjust the probabilities based on the potential to impact the entire enterprise valuation. You also look at the cross-industry variability, because the energy sector being a very important point. What are the higher probabilities? What is the higher impact on the environmental events? What about the tech sector? How do you look at the lower probability of environmental events? What about high impact governance and data privacy risks that it is having? But important thing is, why is it important from the investors? Because you are now able to anticipate your hidden risks that are traditionally hidden by the backward looking or the historical data looking ESG calculations that are generally done. You're able to support your proactive portfolio adjustments and the engagement strategies, because this helps you to understand the insights in terms of help the investors to avoid any ESG laggards before any controversy emerges altogether, so that you are able to align your investment portfolios with the risk resilience that have not been taken, the current ESG performances may not have been taken into consideration. So another way of looking at the ESG ratings factors is in terms of the controversies adjustments, where the ESG might take a score or a score might take a hit, because your MSCI ESG ratings can adjust the company's score downward within days of controversy hitting, and it can have the impact on position of the ESG linked indices as per MSCI ESG ratings details. So that's another way. So you have the weighted way of calculation, then you had the probability risk calculation. Now here is another point that needs to be taken into consideration, and that is about the controversy adjustments that are taken into consideration. So essentially, third mode, I would say, of calculation. There are 3 different modes of calculating your ESG matrices. If you look at the MSCI ESG controversies, this is a thematic framework that ESG has done, and MSCI has done on the ESG controversies. Ranges from your biodiversity to water stress to horizontal operational waste management to impact on local communities, diversity, your data privacy, then child labor, civil liberties to bribery, fraud, controversies and investments, governance structures, and all these factors. And this is a very popularly approach that the MSCI has taken. I would repeat myself. Similarly, Sustainalytics has another approach on the similar lines. Again, the controversy adjustments are taken into consideration when you're doing the source calculation on ESG matrices, because ESG rating agencies, they're monitoring all the time real-time news agencies and the regulatory filings, because any major incident is going to trigger a controversial score, which will directly penalize the ESG scores, and the severity and the recency of the event is going to dictate the scale of the downgrade. So these are the 3 factors, and therefore the environmental factors such as I said, oil spills to waste leaks to illegal deforestation to social factors like child labor to public safety to data privacy to governance, fraud, corruption, misleading disclosures, because it is very important, because any of these points, the controversy-driven downgrades will trigger off a sell-off in the ESG-linked bonds or funds and equity markets, and it will increase their cost of capital if the lenders are tightening the terms. Let's take the case of Volkswagen Dieselgate that happened. So the governance score dropped all the way from A to triple C because of the Dieselgate scandal that happened in Volkswagen, leading to the removal from the multiple sustainability index within the months of the investment event taking place. And that takes me to another point, and that is about, again, the similar lines, figuring out the controversial, and therefore one of the ways the Sustainalytics, as I said, calculates. Let's take another case of, say, chemicals industry, very popularly in controversies all the time. So if we were to look at low risk companies that are there across the board, so they have taken the various companies factors into consideration, and then they're able to calculate the various factors, such as your companies such as Ecolab to Formosa Plastics Corporation to Givaudan and SA to your Industrie Dinara, all these factors. And let's look at some of the severe risk companies when you look at, and if we do the calculation, so it gives us a very high list of companies out here across the board. As I said, chemical industries are very, very, I would say, notorious in terms of the severity of the impact. One can just go out here, check the scores, check the rating scores in terms of the impact factors. And similarly, if I was to take another case of, say, oil and gas industry, which is very, very producers out here, very, very controversial all the time, and therefore adjustments of the risk ratings takes place. So if I was to take a severe risk, it comes all the way from Abu Dhabi National Oil Corporation to Advantage to APA Corp to ARC Resources. So there are a long list of industries you're looking at. And if I was to take a case of, say, low negligible risk, let's see what happens, because the list is going to be very small because of the nature of the industry that it is in. And if one can play around with the low risk to high risk to severe risk. So Topaz Energy Corp is one of the companies that is having a low risk as per Sustainalytics. Now this is again depending upon the various factors, as I said, the companies are taking into consideration. So these are the three ways the companies or the matrices are calculated. The weighted average versus your controversy driven versus your sovereign risk, and your quantifying the probability of the events taking place. So there are various ways these ratings agencies keep on calculating their risks. So now another important factor that we need to look at is ESG ratings in the investment strategy with respect to your noise, signal, what is the market impact, because you see $40 trillion in assets under ESG linked strategies are there globally as per GSIA 2022, and not all ESG ratings are telling the same story. So you have to increasingly decide where these trillions are floating in the capital market, and because the investors are very looking towards this data very keenly, because they are able to provide a proxy for a non-financial risk, such as your climate exposure, your labor practices, the governance, what about the influence on the index inclusion and exclusions. So they are also looking at it from that perspective, like ESG indices, your ETFs, and while it is also being done, we have to make sure that they are being used increasingly by the banks, the insurers, the regulators for both lending as well as for the capital allocation. So the divergence problem is becoming an interesting point out here, because unlike your credit ratings, ESG ratings, they are varying widely due to different weighting factors of ESG, that is your environment, social and governance, and your sectoral basis. So, we've discussed about it in the past as well with respect to oil majors and versus the tech firms. What about the approaches that you need, or the methodologies, whether you need to have a forward-looking approach or only a backward-looking or a mixed approach. So the same company, as we've been talking about, can be a leader in one rater while it can be a laggard for another rater. And when we look at this thing from the perspective of strategic use of investments, smart investors, they don't only rely on scores. So that is one aspect, because I can be a leader in one sector, one rating agency might be a laggard in another one. So what they do is they triangulate across the providers And then within their in-house ESG analytics teams, they combine all the scores. So this ESG analytics helps them to, one, identify what are the various systematic risks, such as your climate regulations, your stranded assets. Two, it helps in spotting the alpha opportunities in terms of the firms which are able to provide or improve your ESG momentum. Third important point is enhancing your portfolio resilience against reputational shocks, whether that can come in terms of your labor crisis, the scams that might be erupting and all that stuff. So therefore, the market impact becomes very important, because the firms with the higher ESG ratings, they typically enjoy lower cost of capital. We've discussed this in the past as well. They're as low as 5 to 10 BPS per Greenham in bonds, and the capital flight from low ESG performance, say, which are working in the brown firms, are actually called as quote unquote brown firms. It's accelerating under regulatory and investor pressure. And ESG is no longer about ethical branding. It's a financial risk strategy you're looking at. Therefore, when we look at the various factors in the corporate, climate change across the board, the positives and negatives, so also the investors and the investor change perspective from the climate perspective. So how it has happened over a time period is what we are looking at. How do you calculate? One of the questions is, how are these numbers being calculated? Because you see, behind every ESG rating is a blend of hard data, industry weighting, judgment calls, and that is what is going to make the breaker of the investment decisions, because ESG scores are not accounting figures. There are multiple factors that are with their risk ratings, where they are blended quantitative matrices and qualitative judgments. So this is a very, very I would say controversial factor, because it's a very judgmental in nature, and therefore any ESG score methodology approach is basically your risk mitigation, investor confidence, brand value. They all are coming out from your ESG score calculations, because the sustainability and the ethics have been taken into consideration by the performances, to the matrices that are there, to the various environment, social governance factors that are there, because ESG ratings agencies, they're sourcing data from company disclosures, to regulatory filings, to NGO reports and media scanning and alternative data, so such as satellites, imagery. Even social media data has now started to play a very, very important role in this regard. And each sector has its own material ESG issues, something we just saw, a few seconds ago. So carbon emissions industry is critical for manufacturing. The data is critical, while the data privacy is very, very important for any tech-driven companies or tech-driven firms. The weighting is there, because that's where your industry-specific weighting is going to ensure your relevance, such as your environmental might be about 50% for oil companies, while it can only be about 15% for a software firm. And therefore the score aggregations, where you're weighting your averages, they're being calculated on each of the different pillars: your environment, your social, your governance, and then the composite score is calculated from 0 to 100, or even the letter-based scoring methodologies like AAA to CCC. Because every time an adjustment is made, because the controversy penalties are reducing the scores of the major events or incidents, and the peer comparison, you're trying to normalize the scores against the industry averages. So the final output is, they are being used by the asset managers, the banks, the regulators, to shape the various capital allocation, the borrowing terms, and investment eligibility. Another thing that brings me to the similar lines is one company, three scores. Why are these ratings being so different? So let's look at some of the three different popular rating agencies. You have MSCI, you have Sustainalytics, and you have Refinitivity. And therefore, you look at the various scales that they have put up, from AAA to CCC to 0 to 100. The scales are different. So here lower is better, here higher is better. The focus again changes, because industry relevant relative performances on ESG issues are there, to your data sources which they take into consideration, to the various criticisms that have been coming across the board. So MSCI, let's take the case of this Tesla as an example. If you were to look at it, so MSCI rated it double A because it was reason given was it was leading the EV adoption, strong product carbon footprint, reducing the relative to auto peers, while Sustainalytics is saying it's a medium risk because you have got a high exposure to governance controversies, which have seen in the past, to labor relations issues, to supply chain risks, to definitive, which is giving a score of 54 because they're saying that it's a moderate disclosure quality, it's got partial gaps in supply chain reporting altogether. So what I'm trying to highlight is that ratings is not a universal truth. There's no single definition of ESG rating performances because the providers are selecting their own material issues, indicators, the various weighting systems that are there. So the same company can have, as I said, if you look at it, this case of Tesla itself, and then you have the divergence in terms of starting with the scope. So MSCI, while it is evaluating a firm's performance in terms of material ESG issues relative to the industry peers, the sustainability is talking about your measurement in terms of financial material ESG risks and the firm's ability to manage them, while Refinitiv is emphasizing on absolute performance based on disclosure volume and content across and the factors that have been put under the ESG pillars. So the result is that a firm in a dirty sector like oil and gas can still get an MSCI AA if the leader is relative to peers, but will struggle to get in sustainability. It might struggle to get this higher scores because the various factors. Then the weighting and the methodology is shifting because MSCI is applying your dynamic sector specific weighting, while the Sustainalytics is looking at risk weighting because it is looking at the issues that pose higher free financial risks, that it's carrying more influence. And the Refinitiv is using a fixed weighting across sectors where you're trying to penalize or reward your disclosure across heavy companies, regardless of the sector relevance. And then controversy treatment, how do you treat is becoming an important factor because you see MSCI is downgrading ESG leaders if significant controversies occur, such as oil spills, fraud, data theft, controversies around all these events, safety events, incidents, while Sustainalytics is looking at severity-based penalties. High severity incidents can drop a company, while Refinitiv is applying the negative scoring weight to controversies, but penalties are smaller relative to the disclosure of the performance. The data sources are one, again, they are driving the biases because MSCI and Sustainalytics, you are looking at a mix of a company self-disclosures with media to NGO to government reports. Refinitiv is looking at heavily weighted towards public disclosures and filings. So the implications are in terms of your firms with more sophisticated reporting teams, they're getting higher scores regardless of the actual on-ground impact. What about your policy and the regulatory angle? Because EU's SFDR and the upcoming CSRD, they're going to push more towards the standardized ESG metrics, while the methodology, that divergence is unlikely to disappear across the board. So one of the questions, again, going back to the fundamental question, same company, different ESG ratings. Why is it so? Because of the multiple factors as explained across the board by various different agencies across the board. Another thing that is coming in today's world is the use of machine learning to predict your ESG ratings. As I said, it's moved from the historical data to more of a probability-driven, event-driven, and controversies that might erupt or might be occurring, and if one can spot that part fast, figure out that piece of the puzzle. So that's where the role of machine learning becomes very important because you're able to now look at the raw signals to the risk source. So if you look at this out here, you have the ESG info hub, where you're looking at identifying the independent variables and the dependent variables, and you're trying to do the arrangement of a 1-year lag to score transformativeness. Then you create your models such as regression models or the classification models. Based on that, you have the training data and the testing data you segregate out. Then you pass it through your machine learning models such as deep learning or XGB Boost or LGM. And then, you determine the value of the hyperparameters, which needs to be tuned. Similarly, on the classification models, again, the same approach, various approaches such as in the deep learning, you're looking at CNN. And once all the final results, they come out, you're able to do your finalized regression models, and then you pass your you're testing data to test the models, because the forecasting of the results is becoming is where you're looking at. And finally, your performance evaluations takes place. So again, out here, the testing data has been divided up into various segments. Generally, it is 60% of training data and 40% of test data. The thumb rule is 70-30, that is 70% of your training data and 30% of the the testing data. However, there's no written rule out there. Generally an assumption that one makes, because the environmental scores, such as scope, as we discussed about 1, 2, and 3 intensity, what is the verified RE share, what are the stress factors on the water, waste, satellite images, methane flaring, all these are taken into consideration as the data sources from multiple environmental sources. What about the social data that we are looking at is in terms of the injury rates or the median pay or the churn and the controversies. How do you handle that? The governance, the board's independence, all these scores are taken into consideration when you're looking at the data factor. You combine them with the various modeling approaches, such as your tabular baseline, such as your gradient boosting, to NLP based, you're doing your fine tuning of the transformers for your filing of the news and other ways. Then you have the remote sensing data. Then you have the graph machine learning models approaches and the temporal model approaches. You pass them, as I said, through your training data, because you're looking at a temporal cross validations so as to avoid any kind of a biases. This is one of the approaches that is taken in any machine learning approach, versus cold issuer tests, checking your generalizations are there or not in the data that has been there. And then you look at the various matrices like MEA or RMSE, which is numeric in nature, to quadratic weighted kappa, which is ordinal letters you're looking at, to Spearman, where you're trying to rank them out, to AUROC, to so as to avoid or to predict the controversies around these data around it, because you're trying to handle your data, your divergence across the thing. One important factor that brings it about explainability and auditability of the various models that are being played around, because any machine learning model, when it throws up a result, it has to be explainable, it has to come into factors. So you have the various approaches in terms of the local sharp for features and salience and attentions for text and images. Then you do counterfactuals so as to reduce the scope 2 by 15% so as to increase your +3 in terms of the ESG points itself. Then you have the model cards and the data sheets so as to figure out your feature lineages and your reproducible runs by doing your ML ops. These are the factors that one needs to take care of when one is building a machine learning based ESG ratings models, because you're looking at across the board, what is the raw data, how it is being produced, what is happening around it, and various other factors. On the similar lines, we're looking at now the world has started to look beyond your ESG scores. You're looking at how do you build measure the degree to which the portfolio weights or are having a higher ESG rates assets relative to the benchmarks, because portfolios with high ESG tilt tend to have a stronger quality and lower volatility exposures, but may underweight value stocks as per MSCI ESG Research Report 2023. So you're trying to measure the degree to which a portfolio overweights higher ESG rated assets, which is, because you're trying to change the portfolio's factor of the DNA itself, the factor exposure interactions that are there in terms of the momentum, the quality, the value, the low volatility. So when you talk about the momentum, you're looking at the ESG leaders, often tend to exhibit stable positive price trends over it, which is important for any investor demand or the resilience of the business, to low volatility, where you're looking at ESG often tilting towards your increasing in the terms of low volatility exposures, because the sustainable firms, they are facing fewer risk shocks to returning of the contribution of the analysis, where portfolios can tilt in terms of your deliver in terms of alpha by harvesting your various factor of the premiums, to overweighting high quality, low volume stocks, to risk management and the implications, to practical takeaways in terms of your ESG integration. Is just not about screening, it's about portfolio engineering problem now, because you need to understand the various factors, the exposures, where you're trying to help the investors anticipate the performance patterns across your market cycles. So another point that brings me to another similar lines is the use of NLP, or natural language processing. And why do I say this is becoming an important point? Because you see, we have got so much of unstructured data in terms of reports, controversial factors, your filings, your social media, various other information that is flowing in terms of text, and one has to read through all these things, and it's not humanly possible to figure out the ratings based on these information that is flowing in. And that is where the use of NLP, or natural language processing, becomes an approach in machine learning becomes very important, because it enables to figure out the pieces of the puzzle fast. If you look at it out here, any unstructured data is holding the key to the early ESG risk detection, and yet remaining largely untapped in the traditional model. That is a very, very important point. This is as per WEF, World Economic Forum 2024. And this is very important, because I say that because if you look at this thing, look at the trading and investment information that has been derived from various data sources, to firms' governance, to ESG disclosures, forecasting, valuation, risk management, financial instrument. All of them are becoming very integral part, and this is all information coming from NLP based approach that is there. And look at another way of looking from the reports to the risk. As I say, the data sources, your annual reports, your CSR disclosure, sustainability report, news, NGO report, all of them feed into an NLP based pipeline, which we call, where we do the first thing first. We have to do the entity recognition, identify the key players, locations, events, sentiment analysis, to thematic classification, such as tagging of the text and the ESG pillars, to risk scoring. And therefore, you feed all this information, again feeds into your ESG based risk dashboards. So the role of NLP, natural language processing, a particular branch of machine learning, is becoming very important, because ESG score providers, they are traditionally relying heavily on structured data in terms of KPIs such as carbon emissions, gender ratios, board independence. But the real signal is actually often emerging from your textual disclosures that have been hidden in the CEO's letters, to the audit notes, to the NGO alerts, to the incident reports, to the social media incidents that are being reported. So the NLP is becoming the entire game changer, as I said, because you're able to do your entity recognition, you identify the key players, the locations, the events, and you can link them to your ESG scores, as I stated here. Then the sentiment and the tone analysis, where you're able to detect whether the disclosure, the spin, the negative, or the various vulnerabilities that are there, to thematic classification in terms of automatically tagging the text to various ESG pillars altogether, the text that are coming around, the words that have been mentioned, or the text parts that are important for the ESG pillars, to trend detection, where you're monitoring your shifts in the language over a time period, so as to you can do the spots, you can identify the spot that is emerging in risks before they begin to impact your KPIs itself. Because in the operationally, the faster the red flagging is there, the identification is there. It's a very important big enabler for any manual review that is taking place. It is consistent, it is bias reducing, the scores across the companies, industries. You're able to integrate your real-time ESG news feeds into the risk dashboards that are there. So any kind of a news feed is going to pass through the entire pipeline, and it's going to immediately be fed into any dashboard altogether on a real-time basis. So let's take an example. As an example, if I was taking any AI-driven NLP model, you're able to flag the suppliers' repeated mentions of, say, temporary waste storage issues in sustainability reports that are there. So every time he's talking about temporary waste storage issues, that means it's, I would say, an orange thing or a yellow card that you need to issue, because the key terms of your ESG risk modeling, you're trying to evolve from a rating after the fact to continuous intelligence gathering, real-time analysis, because NLP is empowering the analyst to extract all the material insights from the narrative data, so as to figure out the ratings factors that needs to be taken into consideration. Another technology that is becoming very important is in terms of the blockchains that we have been stressing over and over again. So even in terms of ESG reporting, the green end, is it the end of the greenwashing? Because the companies using blockchain for sustainability reporting saw a 23% higher trust rating from institutional investors. This is as per PwC 2024 blockchain report from ESG report. report that is coming out, because any trust deficit that is there in the ESG report, so you are able to overcome, because currently the ESG data is often passing through multiple intermediaries and there is a selective disclosure or delays that might be happening, and this is raising an investor's skepticism. It's here that the blockchain's advantage is becoming very important, because then it's a decentralized ledgers which is preventing any post-reporting alterations. So once the ESG performance data has been logged, it is being cryptographically sealed and you have been time-stamped. The impact on greenwashing is very important, because it is making nearly impossible to falsify any environmental or social claims without leaving any auditable trails. You have the multiple stakeholder verifications through NGOs, auditors, investors, because you're looking at the same, all of them are looking at the same source of the truth in real time, and you're integrating with the IoT and AI. So any real-time census feed, real-time data in terms of actual emission levels, or where the blockchains are being, they're becoming immutable, while your AI is able to analyze patterns for any anomaly detection. And the investor relevance is becoming very important, because you're building confidence in ESG-linked bonds, the impact of the fund, the sustainability indices, the potentiality of reducing your capital cost for the verified performers across the board. So the role of blockchain in ESG reporting has become very, very important, as we discussed. Another thing that is becoming important is in terms of multimodal AI scores. The role of multimodal and AI in ESG reporting is again becoming very, very important, because the data types you're looking at is NLP, that is your textual data, to your spatial data, to your financial data, where you're looking at quantitative models, so that you can correlate the ESG performance with the cost of capital, volatility, returns, to diversification, verifying your deforestation rates, which is coming from your spatial data, to pollution spreads, to text data, where you're looking at hidden risks, controversies, progresses on the climate pledges that that the companies may have made. Because the current ESG models, they are actually relying too heavily on self-reported disclosures and static indicators, while when you look at all these real-time data, combine them up together, that gives us a complete textual, geospatial intelligence, the financial signals, and actually giving you a 360-degree view of what is happening in the ESG performances. And how does it actually work? Because you're now able to fuse the entire pipeline. Now you are able to build the entire pipeline, because you have the data ingestion, where you're scraping your ESG disclosures and you're looking at the satellite images. You're able to import your data, market data all together into the various platforms that are there from the various platforms. Then you do your feature extraction in terms of your sentiments and compliances using your natural language processing approach for the textual data. You are able to do your geospatial pattern recognition, such as illegal mining detect. You are able to detect from your space data or the satellite images data, or even images data using drones that may be flowing around, to the financial signals, where you're able to map the ESG factors, and then you fuse the models into a transformer-based NLP model. An approach that is very popular now, so as to pass it through neural networks, a deep learning approach in using artificial intelligence for images, for your classifiers, financials, and then you do your weighted ensemble of the various models for dynamic scoring, because the dynamic ESG output is then coming out. It is real-time updates as the events are occurring. The transparency is there in terms of the score drivers for investor confidences, and this is resulting in reduction of your greenwashing, where the objective, where the verification from multiple independent data sources is there. You're able to do your real-time risk alerts, because you're able to detect your ESG incidents before the quarterly reports are suggested or made. Then you have the investor advantage, because you're able to get more accurate ESG ratings, which is driving your portfolio as per the alignment requirement. And that brings me to another point, and that is, from space to stock prices. How do you do your dynamic ESG scoring in the real time? Because satellites can detect deforestation with about 85% accuracy, when the corporate disclosures claim zero deforestation. This is as per WRI Institute 2024. So the spatial data is becoming the ground truth, where you're sourcing from satellites, your drones, GIS-based databases that have been there, the environmental sensors, because now you're able to detect all your ESG relevant events, where we're talking about illegal deforestation or mining, your methane gas leaks, emissions, water scarcity. Then you can combine that with the financial data from the various market signal and integration. And then you can do your dynamic ESG scoring or profiling. You're able to build your complete pipeline, which is going to be continuously updating, because the ESG scores are adjusting to the near real time as the new data is arriving. The event-driven alerts are there. So any event, say take a case of oil spill or deforestation that is taking place, you're able to monitor them instantly, and this is going to spike up your ESG ratings or bring them down. The investor alerts are there. And then you're able to fuse your scores together so as to eliminate your greenwashing, because now you have got a verifiable and objective and a real-time data. You're able to enhance your risk management because you're able to detect your ESG. You're able to detect your all the data factors and adjust your ESG scores to supporting the regulations and disclosures, because they've been closely tied up with now in disclosures such as CSRD or SFDR and SEC related disclosures are out there. That there are multiple platforms in this regard. One of them is very popularly is there in the is called as global maps. One can go here, one can see. I'll take the case of, say, since we're talking about the vegetation, we'll look at the vegetation itself. They've got data from 2025. You can also have life and the land data. I'm just going to take the land data itself. It'll take you to this website. You can see how it is happening, what is happening. It's going to give you a complete, how do you look at, the rotation of the image crops across the board. You can clearly see that. Then, if you take the vegetation data, if I was to take this itself, how has that changed the satellite observable scale patterns of vegetation the scientists are using across the growth of plant across the board with as a result of the climate and environmental changes and due to the human activity. So they have taken the from 2000 to 25. So you can, as it moves around, you can clearly see the various pattern changes that are happening. If I was to bring this forward slightly for everybody's thing. So let's take the case of from June 2019. And if I was to play this video again, how is this vegetation pattern changing across the board? You can also download these videos. Let's take another one as land surface temperature changes, how it has been happening. And then with vegetation and land surface temperature, they have combined it together. You can clearly see, if I was to just minimize this thing, you see that as it is happening, you can change this patterns. What is the change in the vegetation versus the land surface temperatures that changed around. Another very popular website is WRI, which we've been talking about, and I'm going to talk about the Global Forest Watch because we looked at this thing. You can go down to the website, Global Forest Watch. They have got various data sets. One can view at it, get alert on the dashboards, integrate and see what is happening, the tropical covers, the tree cover analysis. You can look at various reports that have been coming around, read through them, look at the websites, what is there. Let the data load out here. So you see out here, the typical, this is primary forest loss that has increased from 80% from 2023 to 2024. So you can see the moving average to the loss of fires, to the loss of drivers are there. The primary loss in terms of MHA. What are the wildfires that were driving the tropical primary forest across the board, and one can see that there's been permanent agricultural damage that drivers in the 2024 tropical primary forests, wildfire. So this is a pretty good area, and again the various mega hectares that were lost across the board because of the from 2023 in Brazil 1.14 to 6.73 the losses across the countries. One can see that. One can also look at the various events that have taken place. The primary forest loss spiked in Brazil, Amazon due to fires. When you compare the loss of fires to loss of others, again, if you check it out, you can just click on these platforms. You can take it out here. So it gives you a complete loss of moving average to the loss of drivers. What about the loss of fires only that has been happening? So if you can click around, this is the case of Brazil. I would suggest all the participants to go to some of these websites, check out what's happening. You can play around with these platforms. It also gives you a very good spatial approach towards the various information or the data, which are the new hotspots. In the case of Bolivia as a country, to intensifying hotspots, so one can clearly see what's happening out here. To diminishing hotspots as well, they've mapped out sporadic, hotspots. How is the primary forest? How is the other tree cover forest? Then you can Bolivia's Charagua Lamba protected area. They kept fires at bay in 2024. What has there been the approach? I would suggest definitely go down to these websites, check them out, see what the information is all about. It will give you a good understanding the role of ESG ratings, the use of spatial data, how they're being combined together. My name is Atul Tripathi, and I'm Honorary Adjunct Fellow at National Maritime Foundation. Thank you for your time. Swayam Prabha is a very good channel to be associated with, not only as an educator but also as a student. It gives you an opportunity to learn new subjects from industry experts like myself, and also from various professors who are there and experts are there in the field. So this is a new course that I'll be teaching. It talks about ESG, it talks about the analytics around ESG, it talks about the various green financial instruments that are there. We'll talk about risk pooling, we'll discuss about what is the nature of weather indexes, what is the nature of finance that is happening, how is the industry looking at it, what are the legal perspectives, what are the technological perspectives, and also most importantly, what is the analytics perspective that we'll be bringing it out. Swayam Prabha has this government website which is called swayamprabha.gov.in. All you need to do is go down, drill it out, figure out which course is most appropriate for you so that you can find out the best one that is available and which is most applicable for your area of learning. As far as this, the way it is challenged, it is transforming the entire education system, because you see there are a lot of people out there who are spread across the country and they want to get access to good quality education given by professors, experts. This is one of the very good channels to be in.